While the oil market has seen some significant volatility recently, and it would seem that the narrative is doing a 180-degree turn driven by a bullishness because of supply side concerns, now to a relative bearishness because of fears about the demand outlook. So we'll go through some of the drivers in this video and naturally take a look at what the technicals are telling us. So before we talk about what's driving oil prices now, let's go back a few steps and discuss what had been driving the market up until quite recently. Of course, most of this year was about supply side concerns. OPEC Plus in particular, really adamant that it wanted to keep oil prices notionally around that $90 per barrel mark, probably mostly due to the fact that the Saudis are keen to keep the cartel together despite some of the geopolitical risks around the world. But of course, the Saudis themselves is really the marginal player when it comes to driving the oil price in the market, want to make sure that their public coffers are reasonably full to be able to obviously afford a lot of the infrastructure spending and some of the other major projects that the kingdom was putting into place in order to most modernize its economy, but also obviously project a favorable image of itself to the rest of the world. We're talking about buying soccer players there effectively. So we saw a market that was reasonably tight. And if we go back to some of our discussions a few weeks ago, a market that was projected to be in a significant deficit, a deficit so large that we haven't seen a deficit so large we haven't seen for the last 16 years or so. So there was that dynamic driving the oil market back towards around $100 per barrel, although it never really got to that point in time. And then you threw on top of that some of the geopolitical risks that emerged during the early stages of the Israel-Hamas war, in particular the attack by Hamas on Israel, which raised all sorts of fears of broader regional conflicts. Now, those risks certainly haven't subsided. In fact, the conflict is still ongoing, but market participants seem to feel more comfortable that it won't escalate in such a way that, well, for starters, Israel's offensive will be disproportionate, perhaps, and that some other regional players, namely Iran, will not be embroiled, which could result in either sanctions or destruction of key infrastructure, or even simply, if there is a war in the Middle East, supply chain disruptions as well. So those are the things that were really keeping oil prices relatively elevated. Of course, that had knock-on effect to other asset prices as well, including bond yields, interest rate expectations. But over the last week or so, we've started to see demand drivers being a much bigger influence on the oil price, especially last week in response to some weaker than expected US economic data. Now, there was already some concerns about the global growth pulse. Europe has been reasonably tepid in terms of its growth outlook. We've obviously seen a large degree of disappointment in China about its on-again, off-again kind of recovery, which is obviously keeping some downward pressure on commodity prices. But last week, well, US economic exceptionalism had been perhaps one reason why the oil price had been reasonably stable. But we started to get some really clear signals that perhaps growth was slowing down there. Now, the US non-farms payroll report was the most noteworthy development last week. But looking through some of the other releases and outside just signs that maybe the US labor market is softening, the ISM business surveys, in particular, the manufacturing PMI survey revealing a fairly significant drop in economic activity, coming in lower than expected on both the manufacturing and services surveys. But that manufacturing PMI fell to around 46 or so, a drop much larger than forecast, and falling towards areas that are typically consistent with a US recession somewhere into the short to medium term. So as a result, prices have dropped considerably, falling in terms of both Brent and the West Texas Intermediate contract into the $70 mark or thereabouts. And again, it does raise questions about whether the oil price will be more influenced by those demand factors. And of course, just what that drop in and of itself actually means about expectations for demand and the knock-on effects to broader financial markets. Now, there's, of course, then the question of what happens from here as far as the supply side of things. Do we start to see an effort from the US authorities to replenish its strategic petroleum reserves? Maybe unlikely, given the fact that Democrats have proven reasonably reluctant to do that in case it mixes its messages about the Inflation Reduction Act and its energy transition, its green transition policies. But the more important story will be what OPEC happens to do. Earlier on in the week, we did get some signals from the Saudis and Russia that it plans to extend its voluntary production cuts that could potentially be dragged into the new year and maybe could even be deepened if we get any sort of sense that the major players in OPEC want to push that price away from the $70-something mark back towards that $90-something mark. It remains an unanswered question, but one that will be key over the next few weeks. Let's zoom in on the daily charts now and get a sense of some of the key levels we're watching in the shorter term. And well, looking back over the last few days of price action, we can see that there's been a break of a couple of significant support levels around $80 to begin with, which catalyzed that big sell-off that we saw a few days ago, 4% in a session. That followed through after a break of technical support. We'll call it somewhere around $77 per barrel. The next key level to watch, well, it might be a bit of a support zone, but around $73.50 appears to be where, well, the market had some level of previous resistance when prices were back in a range in around May to, say, June, July this year. One noteworthy signal that we are getting in the price action at the moment is the daily RSI is in technically oversold levels. Now, it's typically only when we start to see that momentum reverse, maybe even the oscillator line moving back into technically, out of overbought territory, that it's a signal of a potential reversal. Nevertheless, if we go back to the last time the RSI was in overbought territory, it was around May this year, and it did spark at least a brief rebound in the oil price. So something to watch. But overall, clearly the sellers in control of this market right now. We have the price below the 200-day moving average, which is just above $78 per share. One would think that, again, previous support would act as resistance now. That's around $77. We'll be watching those levels in the immediate future. Once more, overall, it does seem that there is a degree of bearishness from a technical standpoint being conveyed in the charts. Let's begin by loosely defining a range for oil prices, going back and looking at the weekly charts over the last, say, 2 years or so. And you can see here that we've seen buys emerge on dips below $70, while the top end of the range really does seem to be around $90 per share. Now, there is some fundamental rationale for this, especially on the downside. There is the sense that OPEC does wish to, jawbone or at least actually intervene in the market any time that there is something of a push to a level which has, say, a 6 in front of it for Brent crude. In this instance, we are looking, of course, at West Texas Intermediate, or our price on West Texas Intermediate. On the flip side, there's also the sense that perhaps the US is more inclined to refill its strategic petroleum reserves at those sorts of levels too. So we get this kind of, again, fundamental support underneath the market when we get those drives back towards $70 and below. On the flip side, we have seen sellers basically emerge consistently when it comes to West Texas Intermediate on pushes above $90. And we can see there that we actually haven't seen a weekly close above $90 since, we'll call it August 2022. So over 12 months or so now. That's probably more of a demand side factor, that perhaps such high oil prices have a kind of self-limiting effect because of, some weak economic conditions around the world too. There's also that notion as well that extra supply does come online when prices get attractive enough, and you get some rigs that might not have been working or profitable at lower prices starting to, return to producing some level of output. But nevertheless, you can see there, broadly defined, the range is around $70, give or take, to the top side, $90 there for West Texas Intermediate. So those are the drivers of the oil market at the moment, and some of the key levels to watch on the charts. Again, we'll be looking for any further data that confirms maybe some of this weakness coming through in global demand. And on top of that, the supply side factors, which will really be determined by OPEC Plus and whether it wishes to drive oil prices back to, again, notionally, where it is more comfortable with seeing them.